Great trading isn't about predicting the future. It's about exploiting the inverse relationship between probability and reward. Most beginners obsess over win rates, believing that professional traders win 90% of their trades. In reality, most successful trading setups hover between 40% and 60% probability. The key to profitability lies not in certainty, but in the trader's equation. The trader's equation is the mathematical formula that determines if a trade has positive expectancy. You must weigh the probability of success against the potential reward relative to the probability of failure and the risk. If the result is positive, the trade is mathematically sound. There is an inherent inverse relationship between probability and risk reward in efficient markets. High probability trades, like strong breakouts, usually offer poor risk-reward ratios because the stop-loss must be far away. Low probability trades often offer excellent reward potentials. Let's examine a high probability scenario, a strong bull breakout. When the market spikes vertically, the probability of higher prices is high, perhaps 70%. However, to trade this, your stop-loss must be below the breakout point. In that breakout example, your risk is large, and the remaining reward might be limited before a pullback occurs. You are paying for certainty with risk points. This is acceptable for scalpers, but difficult for swing traders looking for large returns. Conversely, consider the trading range. Here, the market is in equilibrium, and the probability of any move sustaining is low. Most breakouts fail, and price reverts to the mean. This is the 40 to 60 zone where confusion dominates. In a trading range, buying near the bottom is a low probability trade regarding immediate momentum. You might only have a 40% chance of a swing up. However, your risk is tiny, just below support, and your reward is large, top of the range. Let's run the math on that trading range reversal. If you risk $100 to make $300, that is a 3-to-1 reward to risk ratio. Even if you lose 60% of the time, the equation remains positive. This explains why many beginners fail. They wait for confirmation, the perfect looking chart. By the time a setup looks 90% certain, the move is often over, or the stop loss is so far away that the mathematics destroy their account over time. Al Brooks teaches that market inertia dictates the market continues what it is doing 80% of the time. In a trend, it continues trending. In a trading range, it continues reversing. Recognizing the current market cycle is the first variable in the equation. Let's look at the pullback setup. This is the sweet spot for many traders. It balances probability and reward. After a trend breakout, we wait for price to move against the trend, then resume. Entering on this bull flag reduces the probability slightly compared to the breakout, perhaps to 60%. But look at the risk. Your stop goes below the pullback, not the bottom of the trend. The math shifts in your favor. We need to structure the decision process. Before every trade, you must estimate 3 numbers: probability, P, risk, L, and reward, R. If you cannot define these, you are gambling, not trading. Defining risk is the easiest part. It is the distance from your entry to the price level where your premise is proven wrong. Never place stops based on a dollar amount. Place them where the chart technicals demand. Defining reward is harder. We use measured moves to project targets. If a breakout leg is 10 points, we often project another 10 points up from the pullback. This gives us a concrete R value for our equation. Estimating probability is the most subjective skill. It comes from experience. A good rule of thumb: if the trend is strong, assume 60%. If the market is confused or in a range, assume 50% for direction, but 80% for range continuation. Let's apply this to a fade trade. The market spikes up to a resistance level that has held 3 times. A novice buys the momentum. The professional sells the close, betting on the 80% chance that the breakout will fail. The professional knows the probability of a successful breakout here is only 20%. Therefore, fading, selling, has an 80% win rate for a scalp back to the middle of the range. The math heavily favors the bears. However, markets are dynamic. As soon as a breakout gets strong consecutive closes above resistance, the probability flips. You must immediately recognize this shift. The equation has changed, and you must exit the fade. This brings us to actual risk versus initial risk. Your initial risk is your stop loss. Your actual risk is usually much smaller. It's the point where you realize the premise is bad and exit early. Professionals manage actual risk aggressively. Another advanced application of the equation is scaling in. If you buy a support level and the price drops lower, your probability of a bounce often increases if the support is strong, and your reward potential increases. Institutions scale in. They buy 1 unit at support. If it drops, they buy 2 units lower. They are managing their average entry price to improve the trader's equation. This requires wide stops and small position sizing. Warning: scaling in is dangerous for beginners. If the market transitions from a trading range to a bear trend, scaling in will destroy your account. Only scale in when the probability of a trend is low. Let's review a complete setup. Here is a high 2-buy setup in a bull trend. This is a second attempt to push prices up after a pullback. It is one of the most reliable patterns in price action. Probability: 60%, trend continuation. Risk: below the high 2 signal bar, tight risk. Reward: test of the trend high, good reward. The math is overwhelmingly positive. This is a green light trade. Contrast this with a barbed wire pattern, 3 or 4 overlapping dojis. The probability here is exactly 50/50ths. The bars are large, so risk is high. This is a no-trade situation until clarity returns. Your job is to wait. You are a sniper waiting for the math to align. If Prob-X reward is not significantly greater than risk, you sit on your hands. Preservation of capital is the primary goal. Remember, high probability usually means the easy money has already been made. When you see a perfect trend, you are entering late. You must accept lower reward ratios or wider stops. There is no free lunch. To improve your equation, focus on confluence. A high 2 setup is good. A high 2 setup at the 20-period moving average is better. A high 2 at the EMA and a 50% Fibonacci retracement is best. Each factor of confluence adds a few percentage points to your P variable. It doesn't guarantee success, but it tilts the math further in your favor. This is the edge we seek. Ultimately, the trader's equation teaches us that losses are inevitable. If you have a 40% win rate strategy that pays 3:1, losing 6 times out of 10 is part of the winning formula. Accept the losses as the cost of doing business. Start looking at every chart pattern through this lens. Don't ask, will this go up? Ask, is the probability times the reward greater than the risk? That shift in thinking is what separates hobbyists from professionals. Master the equation, manage the risk, and trust the math.